The asset value market under government management, a new path to preserve national currency value, control inflation, and increase production. In many countries, due to economic conditions and people's concerns about the decreasing value of their assets, liquidity floods into purchasing assets such as gold and foreign currency. This influx of liquidity causes a reduction in the value of the national currency, intensifies inflation, and reduces production. To address this situation, the government must create a framework to direct the public's liquidity into a new financial market under state management, instead of moving it to physical markets. This market, known as asset value transactions, can serve as an effective tool for controlling inflation and strengthening the national currency by combining financial ownership with liquidity guarantees. In this market, the government, as the seller, offers the value of an asset to the public. Buyers become the owners of the asset's value without physically receiving the goods. The government also commits to converting the purchased asset value into cash at the current market price whenever the buyer requests it. Key features of these transactions. 1. Financial ownership from the start. The buyer pays money and becomes the owner of the asset's value. 2. Cash settlement at the current market price. The buyer can convert the asset's value into cash at any time. 3. High liquidity. Transactions can be quickly converted to cash at the current price. 4. Reduced attraction to physical purchases. People are motivated to invest their liquidity in a safe, transparent financial market with high liquidity. For this plan to succeed, people must trust the government's commitments and market transparency. Contracts should also offer an economic advantage compared to purchasing physical assets. For example, the government could offer the asset value at a slight discount compared to the free market to encourage buying. One potential criticism of this plan is that people's money is spent on buying asset values instead of entering production and development, and no productive benefit is created. To address this concern, the government could provide the funds received from the sale of asset values, instead of holding them, as loans to producers and those involved in production. In this way, these resources would directly contribute to increasing production and economic growth, and the public's liquidity would be used for production and development rather than being frozen in the asset market. Some may raise legal objections to this contract, arguing that in a sale agreement, the subject of the sale must be a physical good. Therefore, asset value cannot be considered as the subject of the sale. Regardless of whether the claim of requiring physical goods for sale is correct, there are two solutions to address this issue. 1. Structuring the contract as a settlement agreement, or 2. Forming the contract as a sale of physical goods with the condition that the government has the discretion to deliver the physical goods or pay the equivalent cash at the current market value when the customer requests it. Expected economic impacts of creating the asset value market under government management. 1. Reduction of pressure on physical markets, reduction of inflation, and preservation of national currency value. 2. Prevention of speculative bubbles. 3. Channeling liquidity into secure paths under government control. 4. Preservation of the value of people's assets without the need to purchase physical goods. 5. Support for production and national development.